Welcome to another video. This is Bill Hanna, the Financial Controller. This is my channel where I share with you my knowledge working for the past 18 years in corporate accounting. Today's video is going to be discussing year-end close procedures. The video is going to be long because we're covering a lot of steps to close the year. So I want you to cozy up, find a good, calm, quiet spot, grab your favorite beverage. Mine happens to be Turkish tea. Get your favorite beverage and get ready for this video. We're going to start with an overview of the file, so let's open it up. All right, let's do a quick overview of the file. And by the way, this file is a free download. You're going to find the link in the description down below. You can download it and then make some small tweaks to it to accommodate for your specific company. So I find that the easiest way to look at the closing out of the year is to look at the categories. We have two main categories, routine transactions and non-routine transactions. Under each of them, there are certain types. So under routine transactions, we'll go over billing accounts receivable, accounts payable, cash and credit cards, employee expenses, payroll and other comp. And then when we get to non-routine transactions, we'll look at the transactions that we don't do on a daily basis. These are going to be accruals of revenue, inventory, fixed assets, other accruals, so on and so forth. So this is as far as type of the activity that we're doing. Now, I'm going to have a column for industry. Under industry, we're going to have retail and manufacturing. We're going to have services. We're going to have software. So you can look at your specific industry and see which one is relevant to the company you work for. And then we'll have a close activity column where we'll talk about the actual close activity. We'll have timing. Timing is going to range from working day -2 to working day 7, assuming that we want to close the books in 7 working days. And I define working day generally to be in the same lines of business days, except that sometimes you have an extra day. If, for example, you're working on Saturday and you define Saturday as a working day when you're closing out the year. Maybe you're working overtime just to close out the books, right? So working day is similar to business day, except it could be slightly different if you're adding an extra day. Segment is going to refer to the segment of the financial statement that we're working with. So it could be revenue, expenses, assets, liabilities, so on and so forth. Okay, so let's go ahead and dive into the file. Many of the steps that we're going to be discussing to close out the year are going to be discussed in other videos that I've made in the past. So what I'm going to do is I'm going to leave links to these videos. I'm going to summarize them in a neat summary in the description of this video here. So you can wait until you finish this video and then you can go back and dig into some of these steps that are separate videos that I've made in the past. Let's begin with billing and accounts receivable. We'll look at an industry, specifically retail and manufacturing. One of the things that you should be doing in the first 1 or 2 working days of the month is that you are comparing a warehouse shipments report to your invoices. And you're doing this as a test of completeness. You're comparing what you shipped to what you invoiced to make sure you have a complete list of invoices on your books and records. You'll also do a similar activity on working day 2 for completeness, which is comparing invoices to customer PO listing. So you get a listing of your customer POs, do some kind of lookup to your invoices so you can figure out whether you have a complete list of invoices. Anything that is not invoiced yet should be something that hasn't been shipped or delivered to the customer, depending on your terms with the customer. Where does your title and risk of the goods transfer to the customer? Is it at shipping point or delivery point? Figure that out first, and then you can compare this listing and see whether you have a complete list of invoicing for the year. A similar test you should be doing for retail and manufacturing is going to be checking for month cutoff. So you should be looking at the shipments that you invoiced at the end of the month, the last 2 days typically, to make sure that you have a right cutoff in terms of transfer of title and risk to the consumer, to the customer. So you should be reviewing the last 2 days typically of the month to make sure you have the right invoices. For services, so if your business is a services business and you don't have an actual physical tangible good that you're shipping, you can compare a list of either job logs or hourly logs to your invoices, right? So you should think of your particular case of a company. If it's a landscaping business, then you have a list of maybe houses and jobs and be comparing that to the invoice listing at the end of the period to make sure you have the correct invoicing and the completeness of that invoicing. If your business is some sort of a SaaS business or a software business, right, and you have a long list of customers, you should be performing a month-over-month flux or fluctuation analysis by customer. So you can be catching any hills or valleys, any fluctuation up or down, and investigate these fluctuations to see that they're legitimate and that they don't signal that you're missing some type of invoice or you're over invoicing maybe in some other cases. So a fluctuation analysis by customer will help in this case. Okay, so the timing of these activities, as we said, is working day 1 or 2 after you finished your billing for the month, and now you're ready to perform all of these tests to make sure that you have the right invoicing in place. Let's go over to the next type of activity that we have here, and it's accounts payable, working day 2. And by the way, if you're enjoying my teaching style of this stuff, you should check out the Controller Academy program, where I'm teaching all of this plus a lot of other things relating to accounting and financial analysis, where you get access directly to me and you can ask me your questions within the program. So in this activity here, we are checking the email inbox, assuming that we're receiving vendor bills via email inbox, checking the inbox to ensure that all the vendor bills that we have in there have been already handled in some way, shape, or form, right? So depending on your case, whether you're getting your vendor bills in an inbox, I don't imagine anybody's receiving these things in an actual physical mailbox, but maybe some of these invoices are sent by actual mail. The other way that I've seen this is that vendors will submit their bills directly in your software if you're using like a Coupa or some other software that receives vendor bills directly. So you should be doing some sort of test to make sure that you've handled all of your vendor bills that you've received. The second activity that I'd like to do is to follow up on unapproved vendor bills. So maybe you've received some vendor bills that are sitting waiting for some sort of approval, whether it's a budget approval or some type of user approval in the company. Filter on those unapproved bills and send a reminder to double check and process these vendor bills so you can close out accounts payable. The closure of accounts payable is a pretty important step for year-end close, because once you close it, hopefully day 2 or 3 at the most, then you can begin to do other activities such as fixed assets, accruals, and other things that can only be done after you close accounts payable. So you see, that's why accounts payable is a pretty important step to nail down and close out so that you can begin your other processes that are built on it. Another important type is going to be cash and credit cards. So what you should be doing throughout the month, obviously for cash, is that you are matching up cash receipts against open invoices, customer invoices, right? So you have cash receipts, you are connecting that to a customer invoice and closing out the invoice. A lot of the accounting software, such as QuickBooks, NetSuite, all of the accounting softwares almost now allow you to connect the bank account to the accounting software so that you have a direct feed of the cash transactions, and you're matching that throughout the month to the open invoices to close it out. Similarly, you're also matching up the cash disbursements to the open vendor bills, right? So you're closing out the vendor bills against the payments that you're making so that you're closing that out. Once you've done that, then on working day 1, you should be reconciling the cash accounts to the bank statement, right? And I made a video on that. I'm going to link to it here and down below in the description, where I show you how to reconcile the cash account in the accounting software to the bank statement and resolve any differences, right? After that, you have reconciliation of credit cards, which is pretty similar. It's also a step to ensure that you've captured all of the expenses in the month, and that the liability account for the credit card at month end matches up with the liability shown in the credit card statement. So now you have a match and you can be comfortable that this is complete. Okay, for type number 4, employee expenses, we're going to be sending an email reminder to employees to submit their expenses. They should be submitting their expenses throughout the month. Hopefully you're not relying on a manual process of them sending an Excel file and with the receipts. Hopefully you're not doing that, because that will take up a lot of time. Maybe you're using Expensify or Abacus or some other tool that helps you capture all the receipts and the invoices, the receipts and other invoices related to employee expenses throughout the month. So you're doing that in working day -2, so a couple of days before the period end, you are sending an email reminder to your employees. Similarly, you're sending an email reminder to your managers to review these expenses because you're relying on the managers of departments to go ahead and review the direct reports expenses before you go ahead and process them for reimbursement. Okay, so this is an important step. The next type is going to be payroll and other compensation. So you're going to be recording the payroll journal entries in your accounting software. Now, a lot of times the payroll is processed within the accounting software. So if you're using QuickBooks Online, maybe Xero, I think some other accounting packages allow you to process payroll directly in there. In that case, you don't need to record a journal entry for payroll because it is already natively within the accounting software. However, in some cases where I process payroll in ADP and other, especially when it's a foreign country payroll, I will get a payroll register report at period end, summarize that, and create the journal entry. And I made a video on how to actually automate this process and make it much faster. I'll link to it here and in the description below. After we've recorded payroll, we can record salary and vacation accruals, right? I made a video on vacation accrual. I'm going to link to it. But basically, if your employees are entitled to a vacation pay if they resign or get terminated, then you have a certain liability at month end to record that personal time off accrual, the value of it as a liability, right? You might have a salary accrual. You will have a salary accrual if the periods of the salary or the payroll doesn't match your accounting period. So say you're doing a biweekly salary or payroll in the US. Sometimes that happens. You have payroll that ends on the 14th, maybe the 28th, and maybe you have 3 days of month end that you have to accrue for in terms of salaries and wages. But if your paycheck matches up December 31st, then there's no salary accrual needed in this case. Okay. Beyond that, you will be doing bonus calculation and accrual. So if your company entitles employees to a bonus payout after year end or quarter end, then you need to be doing a calculation of that bonus based on the achievement for that bonus. So say the company says you would get a bonus if we achieve 90% of our KPI as a company, revenue or net income, then you should be calculating that and go through the chain of approvals up to the CFO typically, and then you can create the accrual for that process, for that bonus. Similar to that is commission calculation and accrual. I put that in working day 3, and I allowed a couple of days to close out the sales for the month, because for commission you need to close out sales typically in some kind of CRM such as Salesforce. All the sales are closed, and then you can go and grab this data and calculate commissions, and from that you can create your accrual and journal entry. There are some systems that you can use for this. So in the past, I've used Captivate IQ. I believe there are a few others that can calculate commissions by linking directly to Salesforce, allow you to mimic the agreement with the salesperson into the platform and calculate the commission and create the accrual journal entries for you so that you can just take that directly and book it in your accounting software. Okay, so that's for payroll and other comp. From there, I'm going to move to revenue accruals. So revenue accruals falls under non-routine transactions. So we finished all the routine transactions, and now we're doing the non-routine. By non-routine, I mean these are things you're not doing on a daily basis or weekly basis. These are things that you're waiting a period end to do. So for revenue accrual, you need to be done with your billing. So billing has to be complete, and then you're doing your accrual. So the first type of accrual is amortization of deferred revenue. So throughout the year, you've received payments from customers maybe that don't have an actual service or good that have been delivered already against these payments. So these are liabilities. These are deferred unearned revenue sitting on your balance sheet. So you need to check on the amortization of deferred revenue. Typically, you would have a schedule for that, and you're just checking your schedule against what's in the accounting package to double check that you have the right numbers. Similar to that is accrual of unbilled revenue. So this is revenue that have been already earned, but you haven't billed the customer for it yet. And that's usually is based on an agreement you have with the customer, where you will bill them at a future date, but meanwhile, you've already delivered some of these services or goods. So you have to accrue for that revenue in terms of earned revenue. So that will entail reviewing new contracts that you have entered throughout the period. And hopefully you have already a process for that you're not waiting on year end to do it. You're supposed to be doing it as they happen. Every new contract that comes in throughout the year, you're reviewing from an accounting standpoint to make sure that you're capturing the revenue for that contract. Okay, there's also a video that I made on this process, revenue recognition under ASC 606. I'm going to link here and down below so you can watch it after this video. Now we get to type number 7, which is inventory accruals. And I put that in working day 3 because I wanted to allow some time to finish your billing completely, right? As you're doing your billing and you're closing out your sales orders, now you are closing out your inventory as well. So I want to wait for that to be done before I can do these reconciliations here, where I'm going to compare your inventory warehouse report to the inventory on the books and records, right? And this is similar to what auditors do when they come in and audit your inventory. They do a physical count and compare it to your books. So you're doing this ahead of any auditor doing this stuff for you, right? You want to be correct on your numbers. So when you compare warehouse reports to inventory, you might find that you either have less inventory or more inventory, and that will require a write-off. So if you find that you have less inventory in real world, then you have to write down your inventory in the books. If you have more inventory, well, that's the opposite, right? You've made an error in the past and you have to true it up now to recognize that extra inventory that you have. So hopefully your accounting is correct throughout the year and you are reducing your inventory correctly as you make sales and you receive shipments of new inventory. The second activity I'm going to do here is to check for obsolete or expired inventory for write-off. So where I've done this in the past when I worked for a food manufacturer, I would look at a listing of inventory by expiration date at year end. So I would look at that report and find out where my goods are either expired or within a small distance from expiring. So let's say it's expiring like this week, right? We're closing the books and it's expiring at the beginning of January, right? So in reality, this goods have no value or little value, because the only value that a food will have at the last week of its expiration is to sell it to a deeply discounted retailer and get pennies on a dollar for this stuff, right? So you need to be doing the correct write-off for that. And if you're unsure how much to write off, you can be talking to auditors to make sure that you're on the same page with how you're thinking of your expired goods or near expired goods, especially when we're talking about food merchandise. Okay. Another step that I'm going to do is to check for goods received where there is no invoice received. A lot of accounting softwares such as SAP and NetSuite will do this process for you automatically. So if there's a signal that the goods have been received but the invoice have not been received, the system will accrue for this inventory and liability for the accounts payable, right? However, if your accounting software doesn't have this feature, then you need to be doing it manually by checking on goods that you've received that doesn't have an invoice or a vendor bill for that good. So you need to be accruing for the inventory and the liability to that vendor. Okay, so that's for inventory accrual. Let's talk about fixed asset and other types of assets. So in working day 3, I'm going to be sending department manager listing of the fixed assets for disposal and obsolescence. So department managers have the most knowledge of the fixed assets in their department. So I'll be sending them a listing of the fixed assets, whether it's laptops, servers, whatever it is, and asking them to tell me whether any of this either got disposed of, broken, damaged, doesn't work anymore, so that I can take a write-off if that's the case. I'm going to also be checking on the additions of fixed assets, right? So you should be doing this throughout the year and throughout the months. Every new asset that comes in, you should be setting up the fixed asset in the system. whether it's QuickBooks or NetSuite. Typically, QuickBooks doesn't have robust features for this kind of stuff. NetSuite does have an SAP. You will be setting up the fixed asset and setting up the corresponding useful life so that you can have the right depreciation of that fixed asset. Another type of asset that you should be checking into is going to be capitalized software. So if you have an internally developed software that meets the requirements from an accounting standpoint to be capitalized, then then you should be speaking to the engineering team at your company and figure out whether they have new projects that qualify to be capitalized as a capitalized software, and you're going to be standing up new assets for them and setting up an amortization for these internally developed capitalized software. If you're unsure, typically what you do is engage an outside accounting firm or speak to your auditors as a starting point to figure out if you have what can be viewed as an internally developed capitalized software. Okay, we'll also be doing a impairment analysis for intangible assets. A famous one is goodwill. If you have any goodwill from a previous merger or acquisition in your books, you should be performing an impairment test at period end to double check that this asset is still a valid asset on your books. You're also going to be reviewing long-term versus short-term asset classification to make any adjusting entries. So a short-term asset is an asset that is has a useful life less than 12 months. A long-term asset is going to be an asset that has more than 12 months of future benefit. So then you should be making adjustments to make sure that you're capturing the right classification. And again, this could be slightly technical in nature. So you're either going to speak to your controller, your chief accounting officer. Sometimes you engage an outside accounting firm to help you come up with the right process for short-term versus long-term assets on your books and records. Okay, now we're going to move on to area or type number 9, other accruals. So the first step I'm going to do is now that my accounts payable is closed, and again, I'm going to emphasize the importance of closing accounts payable, working day 2 or 3, so you can achieve maybe about 7 days of close. So you can achieve closing the period within about 7 or 8 days instead of closing the periods in 15 or 16 days, right? So one of the things I'm going to do on working day 3 or 4, once I'm done with accounts payable, is to check for internal open PO for services for possible accrual, right? So at the end of the period, I generate a list of open POs from purchases that internally we made within the company, and look whether the service have been rendered already, and I'm just waiting on an invoice. If the service have been received, we've received the actual service, then it should be accrued as a liability on the books. Okay. Step number 2 is going to be to accrue vendor bills that are pending approval. So if the vendor bill have been received, the service have been rendered, you should be also accruing for that on the books and not waiting till January to post it to the books, right? So you know that this bill is going to be approved in January, so you should go ahead and create the accrual for it in December so you can capture that expense and liability. You're also going to be doing an accrual for stock option expense. So if your company grants stock options to its employees, then there is an expense associated with that. I made a video on that, so I'm going to link to it, and I'm going to put it down below in the description of how to use the Black-Scholes model to use the grants that you give to your employees and record the stock option expense from it. Beyond that, you'll be doing an allowance for doubtful accounts and AR write-off. So I put that in working day number 3 because I need to be done with my billing. My billing is done in working day 2, and now I'm ready to do my allowance for doubtful accounts calculation and AR write-off. I have a separate video on that. I'm going to link to it as well, so you can go ahead and watch it. Another type of accrual that you're going to be doing is the creation or update of a tax provision. This is a highly technical area of accounting. We actually created an entire course on this subject here under US GAAP. So I'm going to leave a link down below to the course. You can go ahead and check it out. Typically, what you do is if you're not versed or familiar with the area, you would engage an outside tax firm to help you come up with a calculation for the tax provision. The next step is going to be to record the accrued interest. If you have some type of debt facility and you have an outstanding loan, you are paying interest on that loan and you need to accrue that interest. So typically the interest is debited from your account after the period end. And if that's the case, you need to go ahead and debit the expense and credit the liability for the interest portion on the loan. You're going to be also identifying any new leases and reviewing the agreement to see if it qualifies under ASC 842 as a capital lease that you need to stand up an asset and the liability for that lease. Hopefully you're doing this throughout the year and not waiting till year end, but if you haven't, now is the time to look at new leases that can qualify under ASC 842 to be capitalized. Yeah, similar to that, you're going to be recording lease amortization. There is softwares now that you can use to help you with the amortization calculation for capitalized lease payments. So this is one step that you're going to be doing around working day 2 or 3 is making sure you recorded the lease amortization. All right, moving on to type number 10, which is reconciliations. So this is typically going to be working day 6 in this case in our sequence. Balance sheet reconciliation give you comfort that the balances on your balance sheet have support, outside support for these balances. So for cash accounts, the easy one is bank statements, right? So that's why you do a cash reconciliation to the bank statement. But for other balance sheet accounts, anything that has a calculation behind it, you should have a supporting working paper to support that balance. So I made a video on how to reconcile the balance sheet accounts, how to come up with the way to categorize the risk of these accounts, and therefore the frequency of this reconciliation. I'm going to link to it down below. But what I like to use for reconciliation of balance sheet accounts is to use an outside tool such as Flowcast or Blackline to help me organize all of my thoughts and all of my accounts and make sure as a controller that all of the accounts have been assigned to a team member, have been reviewed, and have been reconciled to the books. Then there is a reconciliation of the payroll accounts to the payroll register. You're doing this if you are not running the payroll within the accounting software. So if you're running the payroll within QuickBooks Online, then your payroll register is your payroll account, right? However, if you're running your payroll outside of the accounting software, such as ADP or a similar system, then you have to compare a payroll register at period end to your payroll accounts on the books and records to make sure the expense that you have matches what's on the actual payroll register. So this is another step that you do to make sure that your expenses for payroll are correct at period end. The next type is going to be review Flux Analysis. This is just looking at the account listing month over month. You generate an account listing month over month and do a fluctuation analysis to capture any missing accruals or accounting errors. I made a whole video on how to do this. I'm going to leave a link to it down below. But you're doing this basically to identify accounting mistakes, right? So now you're working day 6. You're very close to closing the books. And now you're just looking at the fluctuation of the accounts to make sure you're not missing anything. Okay, after that, on working day 7, I'm going to discuss the financials with senior management. So depending on your company, when I worked for a smaller organization, about 100 employees or so, senior management for me as a controller was a CEO. So I would sit down with the CEO and I would walk them through the financials to identify anything that I'm missing, because from their perspective as a CEO or CFO, they have a certain view of the financials that you might not have as a controller, right? So they can help you identify gaps in revenue or costs that you might not know about, right? So it is a pretty important step for closing out the year to discuss the financials with your senior management, whether that could be the CEO if you're a smaller company, or if you're a bigger organization, your senior management is going to be your VP of finance or your CFO to identify any potential issues in your financials. Now that you've done all of this and there are no adjustments, if there are adjustments, you're going to be taking these adjustments first, whether to revenue, liabilities, expenses. After all of that's been recorded, you're going to close out the period in the financial system. There's an actual button that you go and check, and you close out the period so that you make sure there are no other bookings or recordings that are made after you closed out the books. Okay, guys and girls, this has been a marathon of a video. I applaud you for sticking out all the way to the end. I'm almost done with my tea here. Thank you for sticking out till the end. Like the video if you liked it. Download this template, share the video with your friends, and I'll see you in the next video.